Honestly, I really want to talk about stocks. I really want to talk about finance. I've got loads to talk about. But Trading 212 keep doing this. Every week they keep messing up or introducing something new. And unfortunately, you guys want me to talk about it. So I will. Welcome back everyone, my name's Paul. I'm relatively new to investing and I've started a dividend investment portfolio with Trading 212. Currently my Trading 212 ISA portfolio sits at 2442. This is more money than I've ever seen before. This is the most money that I've ever owned. And because it's the most money I've ever had, I really want to protect it now. And to protect this money, there's a lot of things that I kind of want to think about. Like I want to think about what stocks I put it into. Do I want stocks that could possibly crash very soon? Or do I want some more safer stocks that will only grow quite slowly, but hopefully won't fluctuate too much as the market grows? I generally have a much more conservative investment style. My aim is to save more than I actually gain. This is something that might not be very popular in the investment world right now, but I'm okay with that. However, some people might have made 100, 200, 300% on their portfolio, and they're in the same boat as I am when picking a platform. And right now I've chosen Trading 212 as my platform. Trading 212 is commission free and it's got a lot of cool features. It's very easy to use. But recently it's been annoying a lot of people by making a lot of policy changes. And just last week Trading 212 made another announcement saying they were going to change the conditions on the way we can fund our accounts. I was always going to cover this because it is kind of important, but I was just going to slide it into another video as a bit of news. But so many of you have been in contact with me on the Discord, on Instagram, and even on Trading 212's Pies feature. I just had to cover it in a bit more detail. And from what I can tell, there is still a lot of confusion around what people think is happening versus what is actually happening. But what these new conditions mean for the customer may not be the most important thing. And stick with me because I'm going to go and try and explain that a bit better. But last week, Trading 212 changed their funding conditions, which means that if you're depositing via a debit or credit card into the Invest or ISA account, then they will charge you 0.7% to make that transaction. Trading 212 want you to know that they're not profiting on this. This is just your debit card processing fee. This is how companies like Visa and MasterCard make money. And on its own, you can see why Trading 212 have done this. I think they now have over $1 billion worth of your securities and your assets sat in Interactive Brokers. $1 billion is a lot. What's 0.7 of a billion? 70 million. So just on a simple calculation there, you can guess that they've already lost over 70 million just in card processing transactions. That's a lot of money for a completely free service. But by passing on these charges to us, if we continue to keep paying by debit or credit card, we will automatically lose 0.7% on our investments. This is not very attractive to customers who up until now have been used to a completely free service. But it's not like Trading 212 have left us without any free options. Not UK residents anyway. Sorry Europeans, I know you've had a bit of a tough time with it recently, and I know there aren't too many depositing options available to you just yet. And I also know that if you want to stay in Trading 212, you now have to abide by UK financial laws, because Brexit. However, Trading 212 have said that they are going to make it quite a high priority to bring in some free options for the European residents. And now we can understand why Trading 212 was trying to build another office in Germany. I'll come on to that bit very soon. But for now, if you're a UK resident, it's very easy to sidestep this 0.7% processing fee. No, don't put it into CFD and then transfer it over. Trading 212 already know about that. It's not going to last long. However, I'll do it now, nice and simple. Stick at the top, deposit funds. And you can choose bank transfer by putting in their details into your bank account and paying in directly, or you can use their instant bank transfer feature. It's very simple, it's very much the same thing as a normal bank transfer. The only thing is they're getting a third-party company to just fill out those details for you. It depends how lazy you want to be. But if I'm adding 500 quid now, I'll type in 500 quid. I've already verified my bank account at the top there, and then I click next. And TrueLayer will direct me to my bank account, and TrueLayer just goes to your bank account and inputs the details for you. That's the only difference. So for UK residents at least, that's how you're going to do it. By doing that or your own bank transfer, you just miss out on those 0.7% charges. Probably something you should consider as a really good idea. It's now going to save you 0.7% on all of your returns. And believe it or not, that was only supposed to be a small part of a much bigger video. Something else was going to be the main topic of the video, and this was just going to be a small part. But the more and more I looked into this, the more issues developed. Like the auto invest feature. This is supposed to be Trading 212's flagship feature. This is supposed to be why you get into Trading 212, because Trading 212 has automated passive investing. But you can only auto deposit into a Pi via debit card. This means that you're going to lose 0.7% on all of your deposits if you use their auto invest feature. They're not even making money off that. It's stupid. And even that's not the bad part. This is just the latest in a long line of cost-cutting measures. On the CFD side, they've changed the margin and even increased the spreads, which is annoying customers on that side. That's probably down to the fact that most people are winning in the market at the moment because of the ridiculous market conditions. Trading 212 just cannot keep up with everyone else winning, because usually it's the one that wins. And from the very limited information that we have, we know that Trading 212 is losing money on the ISA and invest side. Trading 212 had to bring in securities lending earlier in the year to make some money on that side, but the margin on securities lending is probably quite low. You need a considerable amount of assets to get that working. There's been further delayed dividends, and the dividend delays are getting much longer. This could be an Interactive Brokers thing, this could be a Trading 212 thing. And I'm currently trying to figure out why Trading 212 needed to push forward its January profits to increase its FCA buffer. Trading 212 needs to maintain a certain amount of money to protect our assets. And if it needs to dip into that fund to stay afloat and push forward some of its profits to cover that, that feels like a bad situation. But that's a little bit above my ability. Maybe someone else knows it. Maybe it's just a standard thing that Trading 212 do every year. But they've only done this, as far as I can tell, for the past 2 years. I know I shouldn't speculate. I don't have enough information to judge. And I don't know if this is standard practice. But Robinhood is getting fined left, right and centre for doing things without telling its customers. We don't know what these new fintechs are capable of. We don't know what they're capable of hiding. And as individual issues and releases, they don't look that bad. But when you group them together, there's a much bigger picture that maybe suggests that Trading 212 isn't as profitable as we think it is. I mean, look at it as if you were investing in it. On the top line, they're streamlining their service, making themselves more profitable, and bringing new content. Brilliant. That's amazing. However, they are making unpopular and very harsh decisions that are impacting on its customers to preserve their bottom line. When companies on the stock market make decisions like these, their stock price goes down. People lose a lot of confidence in these companies. And I personally don't see these things as red flags. They're yellow flags at best. Maybe Moroccan sunset flags. But if you were thinking about this company like a stock and they were making these uncomfortable decisions, you would expect a manager to come out and reassure everyone. And I think that with all this negative stuff that's been going on, it would be great to hear from some higher ups in Trading 212.
Certainly. Well, so free to download, no cost to sign up, and zero commission. Yeah. Begs the question, where's the revenue here for you?
Well, the revenue will come at a later stage with the introduction of additional services on top of the zero commission execution. I'm a very strong believer in robo-investing and trading, because the obvious next question when we allow people to invest so easily will be, what do I invest in? Well, we believe that the traditional consultants will be to a large extent replaced, at least for the smaller investors, by algorithms who can suggest portfolio tailored to their particular goals in the future, saving and investing goals in the future. And these people, the fees from this service will be still very, very low, but enough for us.
And I'm not the only one. Luke Gibbons has asked this on the forum already. It would be great to hear from some Trading 212 management, like a statement or an interview or something like that, something that can detail the strategy, something that can tell us where they're going, and something that can reassure us of Trading 212's profitability. Just really be upfront with how they're making money, or if they're not making money. If they know where they're going but not making money at the moment, then that's a good thing. If the ISA and invest accounts are not profitable at the moment, but they do have a strong strategy of how they're going to get there, then there is no problem at all. However, while every week I get accused of being a Trading 212 plan or someone who's being sponsored by Trading 212, on weeks like this where I have to talk negatively or even slightly negatively about Trading 212, there's an equal amount of tards that come onto the comments and decide to tell me that I'm fear-mongering or going over the top. So in the interest of fairness, I will say that my money is still in Trading 212 and it won't be going anywhere anytime soon. I still believe that Trading 212 is a better, faster, cheaper and easier service than any others that I've tried out there. And they are constantly releasing new features which are way better than any competition, and they are generally extremely good on release. I know from their last filings that Trading 212 has no debt, and I believe it has no venture capital to answer to. And Trading 212 is easily the fastest growing investment service in the UK. My bet is that they're planning to grow and grow their investment and ISA features at a complete loss until eventually that they get to so many customers that when they start bringing out freemium or premium services, at that point I think they'll be big enough to weather any customer exodus. It's either that or they're really tarting themselves up for a buyout. Either way, it seems like a good deal. Okay, my portfolio is currently sitting at 2442. This is a dividend reinvestment portfolio. The stocks in here are focused much less on growth and much more focused on the dividends that I get paid so I can reinvest them. That's how I plan to grow this portfolio, for now at least. My current deposits are sitting at 18,937. You've got a minus 500 from that because I put 500 quid in cash earlier. So my current deposits are sitting around the 18,400 range. Getting very close to that £20,000 goal. I really think I'm going to do it. And today I'm not going to go through everything, but I'm just going to focus on two stocks that are quite heavily being affected by news right now. One of my favorites is JP Morgan at the moment, which in the last 3 months is up by 33%. This is a huge movement upwards for JP Morgan, and it's a move that doesn't happen that often for them. And it was up based on the news that they were now being given permission to start share buybacks again. Share buybacks, in case you didn't know, are just the company's ability to buy back its own shares. If you buy back your own shares as a company, the value of the investor's shares go up. So instead of dividends, it's a very different way of giving back to shareholders. In some ways, it's a much better way. In some ways, it's not. And this news is actually a double whammy for JP Morgan. The headline says that they're going to deliver 30 billion of share buybacks. That's an incredible number. It's much more than what most companies will give. But another important part that has been largely buried into this news is that the Fed is now allowing them to do this because they passed their stress tests. It means that JP Morgan might be in such a good financial position that it can withstand unemployment up to 11 or 12.5%. This is very important at the moment because we know that US unemployment has gone up quite considerably since the illness, and the unemployment rate peaked at 14.7%. Since April, it has gone down quite considerably, now to 6.7%, up from 4.4% in March. It means that right now, JP Morgan might not be as at risk as we first thought. It means that if unemployment doubles in the next few years, JP Morgan can still operate at a profit. I like those numbers and the market likes them too. JP Morgan currently sits at $124. It's very quickly coming into fair value. It's still slightly undervalued right now, not as much as I'd like it to be, but it's probably still something I'm going to spend a bit of that £500 on. And for the last 7 years, JP Morgan has grown its dividend by a 16% CAGR. 28 and 25% dividend growth is massive for a company. Apple and Microsoft have two of the biggest dividends. You would be looking at the yield and seeing 0.1% or 0.95%. That's not what you should be looking at with dividends. You should be looking at the dividend growth rate. And Apple and Microsoft have both been growing their dividend by 10% per year. That's one of the reasons that makes them great dividend growth companies. And with JP Morgan, if you want to get just a little bit more technical, we can go back to the share buyback scheme. And it's stating it wants to put in 30 billion of share buybacks over, I don't know specifically what length of time those share buybacks are coming over. I haven't actually searched for that. That's my bad. But if you're a bit of a finance nerd and you've seen this new study that's come out recently, which is called the inelastic market hypothesis, then you may find that these buybacks might be worth anywhere between 2 and 5 times their original amount. This study has shown that potentially every $1 of company profits that's used as a share buyback could actually result in $2 worth delivered to the shareholder. And this is based on extremely complicated formulas that I couldn't begin to understand, but this study is really good. If you're into some of these financial studies like the French and Pharma study, then this might be one to look at. Sorry, a bit of a side note, just getting a bit too nerdy there. So yeah, JP Morgan is one of the companies that I probably will be buying this week. Anything really up to $130, that's probably where I'll start slowing down my buying of it. But another company that's being heavily affected by news is Tyson Foods. Tyson Foods is up 9.46% on the 3 months, but it's down 0.32% on the month. Fundamentals wise, this company is excellent in my opinion and very undervalued. It has a dividend CAGR of 30.1%. However, due to what's been going on, its dividend growth has only been 10.4% this year. I say only because it's, 20%, 30%, 40% previously. And to be fair, it's only as low as Apple and Microsoft's. But next year and years after, I believe this growth is going to go up. I do believe it also is going to try and keep its dividend payout ratio at around 30% from now on. In the same way we look at JP Morgan's payout ratio, which is always kept around the 30% mark. That is really good considering the history of the financial industry. But Tyson Foods is getting dicked by news. Meatpacking plants have still been idled. Tyson Food had 7 managers fired because they were placing bets on who got COVID. They're potentially being sued for price fixing. What a crap situation. There's a lot of bad news here, and we're not even considering yet the potential headwinds of vegetarianism. So the company is definitely suffering some temporary bad news, and this I believe is suppressing the share price. This is keeping Tyson Foods very undervalued, which is why I've gone quite heavy on buying it. I feel pretty comfortable continuing to buy this stock all the way up to like $80. And a lot of analysts agree with me, and if you look at Simply Wall Street, they've got a fair value of $117. That's very high in my opinion, but I'll take it. According to Fastgraphs, we have a lot of analysts that are rating Tyson Foods to grow double digits in 22 and 23. However, if you just calculate it at its regular 3% earnings growth, you can still see that right now it should be about $80 to $85. With Tyson Foods, I feel like it would be very easy to predict that over the next 5 years, you'd be expecting to get a 10% return every single year. So they're my 2 favourite stocks right now for a portfolio that might require some diversification. Fair plays if you've done really well on your growth stocks, you're 800% up on Tesla or whatever. If you felt like you were someone who wanted to be a bit more diversified in their portfolio or someone who wanted to be a bit more conservative, I feel like these 2 stocks would be a very good addition to your big CRISPR and your big EV stocks and stuff like that. Your choice though, I'm not a financial advisor. This is just what makes me comfortable investing. I'm more than happy with my 10 and 11% growth this year. I can sleep at night and that's all I need. Thank you very much for watching, guys. The investment app that I use is called Trading 212. If you wanted to get into investing, you can sign up through a link in the description below. If you sign up through that link, Trading 212 will give you a free share which is worth up to £100. There is also a link in the description below where you can look at my entire income portfolio. You can see exactly what companies I have in this pie and how much money I'm planning to spend on them. And if you're into cryptocurrency or just trading in general, I also use eToro as my trading for my Bitcoin. I'm currently at 105% on Bitcoin at the moment, which is absolutely crazy. Bitcoin could continue to go much higher in the near future. I use eToro to buy my Bitcoin. If you wanted to sign up for that, there is a link in the description below. Just remember that Bitcoin and other cryptocurrencies are very, very risky. You could lose a lot of money on Bitcoin. That's why I only have 1% of my net worth in Bitcoin. Also, feel free to check me out on Instagram. You can catch up with me and all the weird stuff that I'm posting on there. And also feel free to check out the completely free Discord where everybody talks about all sorts of stuff. You can get some really good access to news that you might not have seen before because people are always posting really interesting stuff on there. There's also a lot of people on there that are way smarter than me at investing, and they can help you out if you have any questions. Thank you very much again for watching, guys, and if you enjoyed this video, please feel free to like, subscribe, and invest.